Hey everybody, and welcome back to another Twisted Finances video. My name is Andy Wilson, and today we're going to be talking about stocks. So public companies generally have two different methods on how to gather funding for a new project. They can either take on more debt or they can establish equity by offering common stock or preferred stock. These companies will issue a certain amount of shares at a certain price in order to fund their development. And so while they get money for funding for investments and capital expenditures, institutional and individual investors like yourself and me, we are presented with an opportunity for an investment with this company. And like I said earlier, there's two different types of stock. There's preferred stock and common stock. We're going to cover preferred stock first because you're really not going to come into contact with it too much in your investing journey. And it's really not that difficult to understand. And it's really just an accounting thing that I want to get out of the way. So preferred stock is a lot less risky than common stock. Preferred stock acts a lot more like debt because with preferred shareholders, they invest in the company and they get shares back. The shares that they hold are not voting shares, so they have no say what goes on in the company or with the board of directors or management or whatsoever. And another difference between preferred stock and common stock is that preferred stock has dividends that the company is required to pay those dividends. So if a company decides not to pay dividends for 1 year and then the next year they decide to pay dividends, they have to pay the preferred shareholders the dividends for the last year they didn't pay and then this current year that they're paying again. So that's why it kind of acts more like debt more than equity, because the payments or the dividends that get paid to preferred shareholders are a necessity and they get paid before common shareholder dividends get paid. That's why it's a lot more like debt, although it's classified as equity. But like I said, you're not going to run into it too much during your investment career, but it is nice to know about it just in case you do come across it. So now we're going to talk about common stock, and this is what you're going to come in contact with like the entire time. When you go on stock exchanges like WeBull, Robinhood, whatever you use to trade, it's going to be all common stock basically. And what common stock is a lot of people think and have a misconception about common stock is that they actually own a part of the company. That's actually not true. See, a fun little fact about corporations. Corporations are a legal separate entity, meaning that they're basically a human being. They have the same exact rights as us, so therefore they're not actually allowed to be owned. When you own common stock or you own shares of a company, what that means is that you actually have a claim on the income generated by the company's assets. That's all it means when you own shares in a company, is that the company owns assets that generate income and you as a common stock shareholder have a claim or a right to the income generated by those assets. And also, like I stated earlier when I'm talking about preferred stock, common stock is different from preferred stock in the sense that you get voting rights, so you are actually active in the company. A lot of times you don't actually vote yourself. A lot of people vote through a proxy, which they basically just put their answer in and then somebody else records that vote for them. But as a common shareholder, you do have a say in what goes on in the company, as long as the majority of the share owners agree with what you want to be done. But back to the claim on the income generated from the assets, there are basically two different ways a company can take the income generated from their assets. They can either retain those earnings or they can pay it through with something called a dividend. So companies that decide to retain their net income, retain their earnings, are typically technology companies or high growth companies that are looking to take in all the money and reinvest it all back into the business so they can plunge themselves to the top of their list, so they can increase their sales price, which would eventually level out the lack of dividends through capital appreciation for common shareholders, and at the end of the day just lets them stay on the edge of whatever sector they're in. On the other hand, a company can also decide to pay dividends, and like I said when I was talking about preferred stock, if a company declares a dividend payment, they first must pay preferred shareholders their dividends before common shareholders get paid dividends. And this is also evident in a situation where a company goes bankrupt and then needs to liquidate to pay off all their debt. Common shareholders are on the very last of that list. It goes creditors, any other debt, preferred shareholders, and then common shareholders. So in terms of getting back your money in the case of a bankruptcy, you're more than likely not going to be able to recoup your investment with common shareholders. And that's kind of why they give you voting rights, to kind of still give you some incentive so you're not scared to lose all of your money. At least you had a say. So if it goes under, then you're partially to blame, right? But now that we talked about the two main stocks and kind of their characteristics and what they're all about, where do you buy these stocks at? And I'm gonna be dead ass honest with you. I have absolutely no idea where to buy preferred stock. I do not know. I think that it's when a company approaches you individually and offers you an investment opportunity and then they give you preferred share. I think that's how it works. I really don't know. So if you do know, let me know down in the comments. But I do know where to buy common stock. And there are thousands of places on the internet that you can buy common stock, but a lot of them do practice fishy practices and kind of unethical marketing behaviors. So I'll give you a couple of pointers to kind of look out for on what your selection should be. First and foremost, you should stick with the tried and true brokers that have been around for at least a little while, have some skin in the game, and you know that there's really not too much bad news that comes around this broker. So, and a lot of people use it. So something like that. But whatever broker you choose, it should definitely be no commission trades. Like, there are so many options out there that do not charge commissions on trading stocks. There's no reason why there should be a broker that is still charging those commission trades, and there's no reason why any investor should be paying those commission trades. It just doesn't make any sense. You're losing money. You can just get commission-free trades in WeBull or Robinhood. Now, personally, when I first started investing, I started using Robinhood, and that was back in the late of 2019, and then I held through Robinhood all the way until the beginning of 2021, and then when everything happened with GameStop, AMC, and everything like that, it was just kind of fishy to me, and I didn't really like the fact that they had liquidity issues, and that's the reason why they halted trading. And then everything else conspiracy wise, I was like, nah, I'm not going to deal with it. I'm going to WeBull. But now I'm a WeBull boy, and I prefer WeBull just because I like the interface, I like the UI, and I like all of the technical aspects of it. I think it has a lot more to offer than Robinhood, but it also still has a long way to go. Some other solid options would be like Vanguard or Charles Schwab. You know, when choosing your broker, do your research, understand if there's fees. If there's fees, run as fast as you can and read the fine print, you know. But most of the popular brokers are generally the same. So as long as you've got something that is reputable and commission-free trades, it's really up to personal preference at that point, kind of design, UI design, interface, and everything like that. So now you know the types of stock and where to buy stock. Now, what types of stock should you buy? And up front, just a disclaimer, anything that I'm about to say in this section is not financial advice whatsoever. It is just a reflection of what I personally invest in and what I've personally been exposed to in the stock market world. And to keep it simple and straightforward and save a very, very, very long conversation, we're going to talk about two different types of stock. We're going to talk about high growth stocks, and we're going to talk about dividend stocks. And high growth stocks are the stocks that I talked about earlier, not paying dividends. Typically your high growth, really technologically advanced companies that are pumping all the money they can to put themselves on the leading edge in the entire world. So you're not going to get dividends from these companies, but if they execute what they set out to do properly and they do it efficiently, then you will have some very, very nice gains in terms of capital appreciation of just the price of the stock that you bought. On the other hand, dividend stocks are basically your cash cows. Most of them have been around a long time. They've established themselves. They have brand loyalty. They make so much money, really, no matter what they do. You know, like Walmart, Microsoft, people are still going to buy from Microsoft. People are still going to go to Walmart. It doesn't really matter what they do. People are going to use it and they're going to generate income from other people. And there's really nothing else that they can put extra funds into to push themselves on top besides like advertising and marketing. That's why they pay out these solid dividends, just because most of the investors that invest in this stuff are like 67 years old anyway, and they've been paying dividends for 40 years. They don't want to piss off the old people. Trust me, you do not want to piss them old people off. But I mean, now you're asking yourself, okay, you've got high growth stocks and you've got dividend stocks. Well, which one's better? I will tell you, in the investing world and the world of finance, this question is going to come up a million times. It is a never-ending argument of high growth stocks versus dividend stocks. And really the answer is, it depends. I think high growth stocks are more better for young investors that are just early in their career. They have like 40, 50 working years ahead of them. They can put their money towards more risky investment vehicles. And if they lose all of their money, it's fine. They still have 40, 50 years to work to make up that money. And the dividend stocks are generally better for the older investors that are kind of getting closer to retirement, maybe have 10 to 15 years left of working. They're not going to see their portfolio grow a lot, but if they have a solid size portfolio at like an average 4% dividend ratio, then they're making a solid amount of dividends a year. And by investing in these safer dividend companies, they're not really at much of a risk to lose their entire investment. their entire retirement nest egg. Personally, I invest in dividend stocks. I know what you're thinking. You don't look anything like 60 years old. Well, thank you. I take care of my skin quite well. Or maybe it's because I'm only 26. Yeah, I know. Okay, like I just said, high growth stocks are probably better for younger investors. But for me, I'm addicted to something called cash flows. That's why I love dividend stocks, is because I see the cash flow. I get paid for owning that stock, and then I reinvest what I get paid back into the stock and getting paid more dividends on top of the dividends, therefore giving me compound interest on my dividend reinvesting. I just personally think that with dividend stocks, if you're going to invest for a very, very long time, like 40, 50 years, and you have a consistency plan and you stick with it, I really truly believe that dividend stocks will prove to be more beneficial than almost every single investment vehicle out there. And yeah, I know dividend stocks are boring, they're mundane, they're not sexy or whatever, but at the end of the day, I'm not trying to shine all the bells and whistles. I'm just trying to make money, you know? And if I can make a solid amount of money and take on less risk, then sign me up, man. But anyways, that's basically the overview of what stocks are. If you have any questions, please let me know down in the comments. If you did enjoy the video and you learned something, you know, don't forget to smack that like button right on the ass, and feel free to subscribe if you want some more finance content. If you're on this video, I assume that you want to start investing, and the best time to start investing was actually yesterday, but no worries. You can go in the description and you can hit some links up, get some free cash, crypto, and stocks, and go ahead and start your journey today so that you can thank yourself in a year. But other than that, I hope you enjoy the rest of your day, and I'll see you next time.